Arbitrage is the simultaneous purchase and sale of an asset in order to profit from a difference in the price. It is a trade that profits by exploiting price differences of identical or similar financial instruments on different markets or in different forms. Arbitrage exists as a result of market inefficiencies. It provides a mechanism to ensure prices do not deviate substantially from fair value for long periods of time. Interest rates vary between countries based on their economic health, which creates an opportunity for investors. By purchasing a foreign currency with a domestic currency, investors can effectively capitalize on the difference in interest rates in some cases. While these bets are no longer as popular as they used to be, they are still widely used in the financial markets. The most common type of interest rate arbitrage is called covered interest rate arbitrage, which means that exchange rate risk is safeguarded with a forward contract. After all, a sharp movement in the foreign exchange market could erase any gains made through the difference in exchange rates. By agreeing to a set rate in the future, investors can avoid the risk altogether. For example, suppose that the US dollar deposit interest rate is 1%, while the Australian dollar rate is closer to 3.5%, with a 1.5 US to Australian dollar exchange rate. Investing $100,000 US dollars domestically at 1% for a year would result in a future value of $101,000. However, exchanging US for Australian dollars and investing in Australia will result in a future value of $103,500. Using forward contracts, investors can also safeguard the exchange rate risk by locking in a future exchange rate. Suppose that a one-year forward contract for US to Australian dollars would be 1.48, a slight premium in the market. The exchange back to dollars would therefore result in $1,334 lost on the exchange rate, which still yields an overall of $2,169 gain on the position and offers downside protection. Despite the impeccable logic, interest rate arbitrage isn't without risk. The foreign exchange markets are fraught with risk due to the lack of cohesive regulation and tax agreements. In fact, some economists argue that covered interest rate arbitrage is no longer a profitable business unless transaction costs can be reduced to below market rates. Some potential risks include differing tax treatment, foreign exchange controls, supplier demand inelasticity, transaction costs, and slippage during execution. Interest rates vary between countries based on their economic health and various other factors, which creates a potential opportunity for investors to profit. The most common type of interest rate arbitrage is called covered interest rate arbitrage, which means that exchange rate risk is safeguarded with a forward contract. The carry trade is a form of interest rate arbitrage that involves borrowing capital from a country with low interest rates and lending it in a country with high interest rates. Interest rate arbitrage involves a number of risks, namely risks stemming from the dynamics, lack of regulation, and cohesive tax policy in the foreign exchange markets.